Canada's inflation rate dropped to 2.9% in January, and that has many people hoping that interest rate drops are right around the corner, especially those who are looking to enter into the housing market. But the question is, does the 2.9% inflation rate indicate that interest rates are going to come down anytime soon? And what does it mean for the housing market, especially if interest rates do start to drop? And I'm going to cover all of those details in this video. But before I do me a favor, hit the subscribe button and hit the like button so more people like you can see this video. I appreciate each and every one of you that does. Oh, and by the way, if you are thinking about entering into the housing market in the next 12 to 18 months, make sure you stick around till the very end of this video because I am relaunching my Homebuyer Masterclass, which has helped hundreds of Canadians enter into the housing market and save tens of thousands of dollars, all by having all of the information that realtors and mortgage brokers would probably prefer that you don't have. So stick around to learn more about that. But let's get into the real issue here, the issue that you clicked for, which is the inflation data and how that may affect the housing market in the near future. So let's start by jumping in and showing you the most recent inflation data. Now, this is the Bank of Canada homepage, which I love because if you want to know exactly what inflation is looking at like at any given time, or if you want to see what the policy interest rate is, you can pull up the Bank of Canada's website and it is all right there. Now, what you'll notice is that there are three measures here. There is the total CPI inflation, which is at 2.9%, dropping below 3% for the first time since June of 2023. And then you've got these other two, the CPI trim and the CPI median at 3.4 and 3.3% respectively. And I'll talk about in a second what those mean. But first, let's go in and just take a look at the chart so you get an overview of what's happened over the last little while. I'm going to make myself a little bit smaller here so you can see the chart. And if you take a look at this, basically what you can see is that there's been twice over the last year where that total CPI number has dropped below 3%. And obviously when it drops below 3%, people start to get excited because it means that the inflation fight might very well be over. But that isn't necessarily the case because as we saw in June, CPI jumped up quickly back to almost 4% in August, which was really short-lived. Now, that is probably not what's going to happen in this case, but the one thing that you need to realize is that just because inflation drops below that 3% band and gets into the 2% range, it doesn't mean that it's necessarily going to stay there. And on top of that, we've got these other two measures that we need to talk about. Now, what are CPI trim and what are CPI median? Well, I'm not going to go into the details of them, but I will give you the high-level overview. The high-level overview is this. The CPI median and the CPI trim, basically what they do is they eliminate the outliers. So the pieces of inflation that are abnormally high, the pieces of inflation that are abnormally low, and it gives a more generalized view of what's actually happening with inflation. So it's taking out the things that could basically push the numbers broadly in one direction or the other direction. And what that gives the Bank of Canada is a more reliable means of looking at the inflation data. So one thing that people should be aware of is that total CPI getting down to 2% isn't necessarily going to be good enough for interest rates to come down. They're probably going to want to see those median and those trim numbers in the 2% range as well. In fact, if you look back throughout the years, you can see that in general, they're typically trying to keep the trim and the median numbers very close to that 2% number. And on certain occasions, the total CPI will jump up or jump back down, but they're going to need to see all three of these numbers within the band. So what that means is that just because inflation got into that magic 2% range doesn't necessarily mean that rates are going to come down anytime soon. And if something happens that is inflationary and causes those numbers to go back up, well, it could mean that we see interest rates stay high for longer. And the Bank of Canada has made it very clear that they are concerned about persistent inflation. So in other words, they are worried that if they lower interest rates prematurely, that inflation could come roaring back. And as a result, that could lead to them having to increase interest rates again and potentially substantially more in order to rein the inflation back in. So the Bank of Canada, as of this moment, you have to think is taking a very, very conservative approach and is going to want to see those inflation numbers get entrenched in that 2% range before they start making any changes, which means a lot of those bets about interest rates coming down may not end up coming to fruition. Now, they may end up coming to fruition, only time will tell, but the reality here is we need to not get excited. Because if we do find ourselves in a situation where Canadians as a whole end up getting excited, well, we could find ourselves in a position where people start spending more money again, start borrowing more money, and thinking that everything's going to be just fine. And that ends up creating more inflationary pressures that cause significantly more issues. Now, on top of that, there's a whole discussion around external factors, what's happening in the worldwide economy that could play into this whole conversation. If we have an unexpected war, an unexpected conflict, or something that happens from a production standpoint that limits the ability for goods to get to market, well, that could bring back inflationary pressures and we could find ourselves back to where we started. But more importantly, there's one other thing we need to be paying attention to, and that is shelter costs. Because shelter costs are making up a very large percentage of the increased inflation. And as a result, that is being watched carefully. In fact, some economists are suggesting that shelter should be eliminated from the CPI altogether, which might make sense, but also doesn't necessarily make sense, especially considering the fact that we have this new issue, this lack of supply issue relative to immigration, and that issue is not going away. So, if interest rates do start to come down and people become more confident in being able to buy a home again at lower interest rates, or even if there's just the expectation that interest rates are going to come down, they may get more confident and start buying more homes, which could lead shelter costs to go up because the values of houses go up, and subsequently that could lead to higher inflation again. So the housing market is really the one place that needs to be watched when it comes to inflation and when it comes to interest rates. Because in the event that the Bank of Canada lowers those interest rates, it could spur on more action in the housing market, and then that could lead to, once again, higher housing prices and higher inflation. See how it kind of becomes a self-fulfilling prophecy? Oh, interest rates are lower, things are going to get better, or interest rates are going to come down, so I'm going to buy more real estate. Oh, and then that leads to higher inflation, which leads to higher interest rates. So what does that mean if you are potentially going to buy a home? Well, first and foremost, as of this filming, it has never made more sense to get a 5-year fixed mortgage. If you were taking a variable rate mortgage, expecting interest rates to come down 3 or 4 or 5 times to make you better off than what you would have been if you had taken a 5-year fixed mortgage, well, you're probably in for a rude awakening, especially if those interest rates don't come down. Now, on top of that, if you get the right mortgage with the right lender, one that has lower prepayment penalties, so in other words, any lender that is pretty much not a bank, well, you still give yourself the ability to have that low rate fixed rate mortgage and at the same time have the ability to switch into a lower rate in the future if it makes sense for you to pay the penalty to get the lower interest rate. So there are strategies out there in order to benefit from lower interest rates while still protecting yourself in case this inflation fight isn't over. And that is the most important thing here when it comes to buying a home, is if you're buying a home in 2024, you need to make sure that you're buying a home that you can afford for the next 5 to 10 years. And the best way to make sure that you will be able to afford it is by getting a mortgage that is substantially cheaper than the going variable rate. Oh, and by the way, my views here haven't changed before everybody hits the comment section and says, you talked about variable and adjustable rates before. Yes, I always talk about choosing the mortgage that has the lowest rate at the time that you get the mortgage, which right now is the 5-year fixed by a long shot. And that is all based on the Mosh Milewski study done in the Schulich School of Business back in the early 2000s. And the data shows that more often than not, that is the best strategy. Although it wasn't the last couple of years, but nobody really could have foreseen all of the inflation that came and all of the problems that happened in the economy. So that is very much an outlier situation. So when it comes to buying a home in 2024, keep in mind that if it appears that interest rate decreases are imminent, that could lead to higher prices very quickly. And in addition to that, if inflation continues to go up and interest rates have to go higher, well, you could end up paying significantly more a year or two down the road anyways. Either way, the Canadian real estate market is kind of in between a rock and a hard place. If interest rates go down, chances are prices are going to go up. And if interest rates go up, well, housing costs are going to go up, but because there's so little supply, housing prices are probably going to stay pretty flat. So this is one of those weird markets where it's hard to make a case for waiting to buy a home. In fact, I think the only thing that is clear here is that anybody who can take the opportunity to buy a home without getting into a bidding war and without having to pay a ridiculously high price for a house is probably making a good decision. Because at the end of the day, whether you're buying at the top of the market or the bottom of the market, whether you bought mid-2021 or whether you buy 2023 or 2024, the reality is 25 years from now, when that house is paid off, the top of the market, the bottom of the market, and any dips are really just blips on the radar. So if you can buy a home that you can afford and that you can pay off in the next 15 to 25 years, you're likely going to be far further ahead than had you waited 3 to 5 to 10 years for the market to drop back down. And yes, there will be a time when the market drops. The question is when. And it's looking like, given the lack of supply in the market and the continued push for immigration, that time is probably a long way down the road. In fact, it's probably more likely that we see wages increase relative to home prices than we see home prices decline relative to wages. Now, at the beginning of this video, I mentioned that we're reopening our Homebuyer Masterclass. We'll be starting in the first week of March, and just so you know, my Homebuyer Masterclass is a course that is designed to give you the information that you need throughout the buying process when you need it. So in other words, if you're in the early stages of getting a mortgage, or if you are in the later stages of actually buying a home and maybe doing a home inspection, you will be able to pull out the module that you need at the time that is most relevant to you. And all of the modules are designed to take the fear out of the buying process. You'll be able to watch the video, take the lesson, and then be able to make good decisions based on the information that you gain. And by working with a good realtor, a good mortgage broker, and having that basic education that you need to have in order to buy a home that really doesn't exist anywhere else in Canada, you will be one of the most informed buyers out there. So whether you are a first-time home buyer or you're somebody who has bought a home before, this course, this information is perfect for you. And by the way, on top of that, you also now get the Rate Secrets 2.0 course included, which is a course that we used to charge $250 for. I've also included a personal finance course for homeowners, as well as a negotiation course that has all of the negotiation tips and tricks that your realtor probably doesn't want you to know, because you're probably going to use it to get a way better deal. Oh, and on top of that, we have all kinds of new things like how to buy a 90% perfect home and make it a 100% perfect home without having to pay over market value for it. Oh, and as always, we've put an offer in there so that if you do take the course and you do choose Mortgage 360 for your mortgage, you'll get 4 to 5 times your money back. So it is a no-brainer. It's essentially free. And on top of that, we've got a 100% money back guarantee. So if you learn absolutely nothing from the course, I'll give you your money back. Now, there is a limited number of seats, so go to homebuyermasterclass.ca. I'll link it in the description below and pin it in the comments and get your spot now. Oh, and if you sign up within 30 minutes of watching this video, you'll get an added bonus. I sincerely hope to see you on the other side and to be a part of your home ownership journey. Oh, and if you want all the latest rates and all of that good stuff so you know exactly what mortgages are priced at now and you can see why it makes no sense to take a variable rate versus a fixed rate, well, check out this video right here.